Welcome to the Lauder Institute at the University of Pennsylvania. I'm Jules van Binsbergen, director of the Institute and a finance professor at the Wharton School.
And I'm Jonathan Berk, a finance professor at the Graduate School of Business at Stanford University. This is the All Else Equal podcast.
Welcome back, everybody. Today we have a returning guest, a fantastic guest, to talk about CEOs. Whereas we talked in the previous episode about how do you become CEO, today we would like to address the topic of CEO compensation, which of course is a topic that's received a lot of attention. I think that in many news outlets, you often read that CEOs are just structurally overpaid. And I think that that argument is mainly motivated by the fact that the numbers are just high. When people see a salary of $5 million or $10 million, they think which person could possibly be worth $5 to $10 million. And then there are a bunch of people that compute ratios of how much the CEO makes relative to other employees. And then those ratios are higher or lower for certain companies. And so today we really want to give some insight into what could be the driving forces of CEO compensation, and then also get to the question, are CEOs overpaid, correctly paid, or underpaid?
Well, Jules, I don't think anybody in our audience is going to be surprised when they know my perspective, that I think CEOs are grossly underpaid. I look at this and I wonder, because in other contexts, people don't seem to object. When Michael Jordan earns an enormous salary for providing an enormous amount of entertainment for everybody, nobody says anything. Film stars earn gigantic salaries for seemingly doing very little. So I don't know why CEOs are singled out for making so much money. And you and I often talk about this because, as our audience knows, we have a lot of work on money managers, and our work on money managers has an interesting result in it, which is that money managers get the benefits of the rents they create. And all the value added money manager makes, we have a lot of evidence that shows accrues to the money manager, not the investors. And I would say it's hard to believe that's true for CEOs. If you look at the value, I don't know, Jules, the numbers for the Starbucks incident that just happened where they hired a new CEO and the stock price went up in the billions, I think. And the CEO's salary was a lot less in the billions. So it looks like that CEO is not capturing anywhere near the rents that he's adding.
No, indeed. If we see that when the new Starbucks CEO comes from Chipotle and the Chipotle stock price drops immediately upon the announcement and the Starbucks price goes up, and we compute the change in the stock price times the number of outstanding shares and we get numbers in the billions of dollars, then of course it is clear that this CEO will never get paid those types of amounts of money. If we look at S&P 500 companies, the average CEO doesn't make billions of dollars for sure. It's more like a couple million of dollars or maybe $10 or $20 million. That's about it. Of course, compared to other employees, that seems like a very big number. But the question is, relative to the value that they add, the responsibility that they have, is that a big number? And one thing that I think we need to immediately establish that a lot of people underappreciate is that if a CEO makes a couple bad calls, the whole company's over. And honestly, I think that Nokia is a perfect example of this, right? Not going into the smartphone market when they should have, and then being outcompeted within no time. That one bad call essentially means the end of the company, including the jobs for all the people that used to work there. So I think that the amount of responsibility that you have over the scale of the company, and this is something that you and I have talked about a lot in mutual funds as well, right? We're not just interested in percentage returns and whether you do 1% or 2% better. If you manage a humongous thing that's worth hundreds of billions of dollars, a 1% difference very quickly turns into a lot of dollar value.
Jules, there's really nobody in the world who has more expertise on these exact questions than Dirk Jenter. We had him on the show previously. It was our most listened to show. So let's welcome Dirk back. Let me just give the background for the people who don't remember. Dirk is professor of finance at the London School of Economics and really the world-leading expert on CEOs, compensation, and all aspects of the job. Dirk, welcome back to the show.
Thank you so much for having me, Jonathan and Jules. It's been a real pleasure. You told me that our last podcast was popular. Let's see whether we can do a little bit better this time.
Yes, absolutely. So Dirk, what we want to talk to you about today, well, let's first remind our audience what we talked about last time. I think most of them remember, but it was how do you become a CEO? And now today we're going to talk about what are CEOs getting paid and is that salary the right amount? So are CEOs getting overpaid? Are CEOs getting underpaid? Are they getting the right amount? And of course, I think the key question we need to get into is how could we actually measure that? Or is it really difficult to get to that?
It is an incredibly difficult question. And I realized that as I was sort of putting my notes together that my answers are likely to annoy absolutely everybody who's participating in that discussion. So let me start with a pretty strong claim, which is that I believe there's absolutely no evidence that CEOs are overpaid. And let me just offer a few observations to back up this claim. We're talking about CEOs of publicly traded companies. So let's think about S&P 500 CEOs in the US, and they're paid an awful lot of money. I think we can all agree about that. I might be getting numbers a little bit wrong, but I think last year, so the last proxy season, I believe median CEO pay, so for the typical CEO in the S&P 500, we're talking about $15.5 million. When you take average pay, because it's a bit right-skewed the distribution, you're probably at 18, 19, maybe close to $20 million. So however you look at it, that's an awful lot of money. And a lot of people are upset about it and says nobody can be worth $50 million a year. So let me just be very clear in saying that's wrong. That's absolute nonsense. Observation number one, shareholders seem to be very happy to pay those amounts of money. There's no evidence that there's any coercion or malfeasance in how CEO pay is set in large publicly traded companies in the US. There used to be a theory, and there probably still is a theory, that high CEO pay was all explained by bad corporate governance, by CEOs somehow putting their friends, cousin, and mates on the board, somehow putting pressure on the boards to pay them very large amounts of money. That hypothesis simply doesn't fit the data. I mean, if you think about the last 40 years, which is sort of the period over which CEO pay has really exploded in the US, from about 1980 to today, this is a period over which corporate governance has pretty continuously improved. I mean, 1970s corporate governance was genuinely bad. I mean, in the 1970s, CEOs got away with an awful lot of bad behavior. Since then, governance has tremendously improved. Companies are so much more focused on shareholder value creation today than 40 years ago. So the notion that somehow in parallel CEO pay has exploded because governance has gotten worse simply doesn't make any sense. I mean, a very recent trivial observation, but a fun one is, you've probably all heard about Elon Musk's fairly large pay package, right? So he got a big pay package in 2018. Which people now throwing around this 50-something billion dollar number, which is a bit of nonsense. Right? I mean, the number he got in 2018 was company estimate, which is probably not a bad one, about $2.3 billion. And that's for 10 years, right? It was the idea is he would be paid that kind of amount of equity for the next 10 years. Ex ante value, about $2.3 billion. And extremely risky, because there were enormous number of performance hurdles in there. So you'd only be getting a lot of equity if he passed all of these performance hurdles. Now, funnily enough, by 2024, by today, he's actually passed all of these performance hurdles. And they were truly crazy. I mean, we're talking like, I think to get all the equity tranches of that 2018 grant, stock price had to increase by, I believe, 1,200% or something like that. And revenue had to go up by many, many multiples. Profits had to go up by many, many multiples. Now, it so happens exposed he had hit literally all of these milestones. So yes, by 2024, that package was worth an enormous amount of money. Let's call it 55 billion or 56 billion, the numbers that are floating around in the press. But what then happened is the Delaware court kind of rejected a pay package, said it wasn't set in the correct manner, the governance wasn't done correctly. So they brought it back to a shareholder vote just a couple of months ago, and it again passed. Vast majority of shareholders were again very happy to vote yes, and to basically saying, no, you absolutely deserved that, here, have the money. So again, there's no sense that shareholders aren't on board. We did a survey of UK investors and board members about CEO pay a couple of years ago, where we asked board members, directors, the people who set CEO pay in the UK, what would happen if you lowered CEO pay? And the almost uniform answer would be, it would be bad for shareholder value. We don't want to do that. So again, directors don't feel like, oh, I'm being coerced into paying an awful lot of money. They're saying, no, we're paying so much because we're trying to maximize shareholder value. Paying less would be detrimental. So that's sort of observation number one. Shareholders, the employers here, are doing it voluntarily. Observation number two, again, back up that claim that I don't think they're overpaid on average, is that the contribution of CEOs to these large publicly traded firms are indeed very, very large. And to be clear, it can go both ways, right? If you have the wrong CEO, it can do an awful lot of damage. But if you have the right CEO, that CEO will create a lot of value. And again, keep in mind how large these companies are, right? If you have a company with a market capitalization of $50 billion and you have a CEO who increases firm value by just 1%, that's not an awful lot, right? If I think, look, I'm hiring person A because I think person A will increase firm value by 1 percentage point more than person B, well, 1% of 50 billion, if I can still do math, is about $500 million, right? That's an awful lot of money right there. And we're just talking 1%. Starbucks hired a new CEO, Brian Nickel, who had been a CEO of another large company. I never really know how to pronounce them. It's this Chipotle or so, the burrito place. Okay? So he used to be CEO at Chipotle. On the day that he was hired away by Starbucks from his previous employer, Starbucks' stock price went up by about 25%, something on that order. Chipotle's stock price went down by about 8%. And if you add these two market value movements together, we're talking something on the order of like $25 billion. Compared to that, the levels of CEO pay we're talking about are frankly minuscule, right? And yes, I believe Brian Nickel got something like an $85 million sign-on bonus, which largely replaces stuff he's giving up at his previous employer. So again, we're talking large amounts of money, but again, it's a tiny fraction of the amount of value creation that at least investors seem to be assigning to that new CEO. So I think putting all of this together, again, I would claim that there's very little evidence that they're overpaid, at least relative to their contribution to the firm.
So, Dirk, one of your specialities is CEO and CEO pays, and Jules and I have a speciality looking at mutual fund managers. Now, if you look at these two markets, in many senses, they're very comparable. As you were talking there, I was thinking, yes, it's also true in mutual funds. Mutual funds, the top managers manage large funds and add an enormous amount of value. And then the managers that manage the small funds are the ones that are banned and destroy value. But since most of the money is with the big funds, mutual fund managers, on average, add a lot of value. But there's one stark difference. If you look at the mutual fund literature, all the economic rents flow to the mutual fund managers. In other words, we can add up how much value they add, and we can add up how much value the investors get of the rents, and the investors get essentially nothing, and the managers get all the rents. For CEOs, you don't see that, as you just pointed out. They add an enormous amount of value, and their pay is a small fraction of that. In that sense, CEOs are vastly underpaid. Why is that?
Did I mention at the very beginning that I will try my very best today to annoy absolutely everybody involved in that conversation, in that discussion? I'm now really about to do that. So I already made the claim that I don't think they're overpaid. In a very specific sense, I don't think they're paid more on average than their contribution to the firm. I don't think they're paid more than their value added. But that's not the only number that matters here. Because if you go back to basic economics says two things about CEO pay. Number one, no CEO should be paid more than her expected contribution to firm value. Understood. That's what we've been talking about, and I'm claiming that's not really happening, so all is good. The second thing that basic economics says is, well, you can't hire a CEO, you can't retain a CEO if you pay less than what she could get elsewhere, right? And what we in econ lingo call the outside option. Now, my claim is that for CEOs, these two numbers are often very, very, very different, because CEO's contribution to the firm is really about matching a specific CEO to a specific firm. And if you have a CEO who's been in a company for a long time, really knows the company, knows the products, knows the processes, knows the politics, knows who to call and to get things done, that's a good CEO, right? That person will get things done. Just Parachuting in an outsider is often very, very, very difficult because there is a lot of what we sort of in shorthand call firm-specific human capital. Knowing how stuff works in a specific company and being a good match with that company is very, very valuable. So take Nadelli, right? Great CEO by all accounts, running Microsoft. So he's adding a very, very, very large amount of money to Microsoft. Adds a lot of value to Microsoft's value. I can't give you a number, but it's going to be many, many $billion. Now, if you take him out of Microsoft and you put him into a different company, that value added is going to be significantly lower, right? Because he's losing all that knowledge he has about Microsoft, all the connections he has, all the network, all of those things. So there's a big gap between these two numbers. So let's just purely hypothetically, obviously not about Nadelli, numbers that are going to be larger. Let's say we have a CEO who adds $1 billion and the company is currently at. The next best company he could work for, he's a very capable person, she would add $100 million. All present value of all expected future contribution. Notice there's a $900 million gap between these two numbers. Right? So basic economics says, well, you should stay in the company in which you're adding the most value. And that should happen. But that now means that the CEO's threat point is, if you pay me less than $100 million, I can go elsewhere. So the board knows we cannot pay less than that. Again, that's expected value of all future compensation, right? Not necessarily per year. And the most the board should ever be willing to pay for that person is $1 billion. Notice there's a huge gap in between these two numbers, right? There's what we call surplus on the table, and now it's a pure surplus splitting game between the CEO and shareholders. Now what starts mattering is bargaining, the psychology of the board, the psychology of the CEO, notions of fairness, even social and cultural norms, right? I strongly believe, let's say, the norms on how that kind of surplus would be split is quite different in, say, Japan versus Sweden versus the US. And I think now, sort of finally circling back to your question, Jonathan, CEOs get less than their value added. I also believe many CEOs get quite a bit more than their outside option. Right? Because, I've done a lot of work on CEO turnover, or let's call it brutally CEO firing. CEOs are very unhappy when they're being fired. When they get fired, they don't go elsewhere to another CEO job. Right? They sit at home and grieve and are very, very upset, and they might never be a CEO ever again. And their earnings go down very, very significantly. So yes, they get less than their contribution, but they also get quite a bit more, many of them quite a bit more than their outside option. Now, from an economic efficiency perspective, there's nothing wrong with that, right? That is really just how the pie splitting ended up. But then I can circle back to the mutual fund managers, because I believe for those, these two numbers effectively coincide, right? Again, with a few caveats. But look, there's not much about firm-specific human capital. There's not much about matching. If you're running a mutual fund, you guys are the experts, but I imagine you basically pick a bunch of stocks. And if you're good at it, you're going to achieve some alpha, you're going to make some money. Absolutely brilliant. But it doesn't matter all that much whether you're doing that within Fidelity or within Wells Fargo or within Vanguard. And if you're doing a really, really good job and Fidelity is trying to pay you less than your contribution, well, Wells Fargo would have an incentive to come in and try to poach you away. And so competition of mutual fund families against each other for these very movable people with very portable human capital naturally should drive their market wage up all the way to their economic contribution.
Okay, but Dirk, I'm going to push back. Let me push back.
Yes, please.
First of all, I agree with the observation. Obviously, there's no matching issue with mutual funds. So that is an absolute correct observation. But here's where I have an issue with what you said. If you were right that matching was so important, why would you ever hire a CEO from the outside? Why wouldn't you just promote from within?
Well, that's what we do.
Yeah, and Jonathan is obviously raising a very, very good point. Let me start with Jules' point, which is that they do, right? In the sense of that 80% of all new CEO hires are indeed insiders. I think it's 81%, 82% or something like that in our sample. And that's exactly the S&P 500, right? Which I always believe are the firms that should be most keen on attracting the best human capital out there. And they can easily pay any search firm and are extremely visible. So everybody knows they're looking for a CEO. So they should be primed to hire absolutely any manager in the world. And they end up promoting internally 80+% of the time. So they have an extremely strong bias towards insiders. And I believe for exactly that reason, right? Because that matching is incredibly important. Firm-specific human capital is enormously important. When they go to the outside, which they do, it's usually because they're in a crisis situation, right? Because things have gone badly, because they feel that the company really, really needs to change. And they don't want to promote anybody from the current leadership team who's in any way associated with what's, to put it starkly, sort of the failed strategy of what they have implemented in the past. But Jonathan, this is an extremely good point. This is actually very much the point my research is at currently. So I've been doing work on CEO compensation and pay for about 20-something years. And over the last few years, it's really become clear to me that I will never understand CEO pay until I understand the CEO firm matching an awful lot better. So I've kind of started writing now papers about CEO firm matching. And I cannot claim I've gotten very far beyond just documenting the basic facts, but the basic facts are indeed they're enormously biased towards insiders. And when they go to outsiders, right, it also often doesn't work out very well. Right? Now we have to be careful. You really can't make any causal claims here because, as I already said, they're only going to outsiders when things are already going badly. And then afterwards, things often go absolutely horribly wrong. Also notice, when they go for outsiders, they tend to then very often go for absolute superstars, right? So we just talked about a Starbucks case where they hired now an extremely successful, well-established CEO of another company for, bluntly, an enormous amount of money. Chances are very much worth it, certainly an expected value. I mean, we'll see how it works out. He's walking into a difficult situation, but from an expectation perspective, probably absolutely worth it. But they didn't go for an unproven entity. They didn't go for somebody who hadn't already done it. They kind of played it safe by going for an absolute superstar and bring him in for an awful lot of money.
I do have one clarifying question because also thinking about what drives what, right? So generally in finance, we make the point that proving that something is worth something is much easier in a liquid market where you can easily buy and sell it and you can just immediately prove what the market price is. So in some sense, what we're saying here is that, and you've made that point in our previous podcast, that actually the market for CEOs isn't such a liquid market because we don't see people being CEOs at 7 different places. Whereas I think that the market for mutual fund managers is probably way more liquid because mutual fund managers do regularly switch jobs. And so the question now is it the case that the outside option is just may actually be not 900 million difference between 100 and a billion. It's just that it's really difficult to prove what the difference is because the liquid market isn't there. So what's the chicken and what's the egg?
Look at it from the perspective of a board member. A board member is looking at the people in the pipeline within the company itself. We've been doing leadership training, leadership development for a long time. We've got a few people who we think might be future CEOs. And at the same time, looking at hopefully a few outside candidates, people at other firms. Now, with the insiders, you have a massive information advantage, right? You know them, you've seen them at work, and you know that they kind of work with the company. And they already have their network within the company. I think that's something that's often really, really underestimated when it comes to managing. If you know who the right person within the HR department is, and you can just call that person and can just say, look, I don't know exactly who to call right now. I know who to get this done, but I know you know. Can you please help me out? Things get done. So that's the kind of skills which are very, very difficult for an outsider to replicate. And I think they're enormously important for a CEO, knowing who the good people in each one of the many divisions of an S&P 500 company are, whom to promote, whom to ask for help, how to get information out of different corners. I think that's enormously difficult for an outsider to replicate. Now, on the other hand, your point is extremely well taken. We just don't know how good an outsider would be. There's just very, very little data. And this is another sort of huge difference with the mutual fund managers. Performance is so much more observable. Now, I still think it's really quite difficult to observe for mutual fund managers because you do need an awful lot of data. And just looking at realized returns probably isn't good enough. But if you actually dive into what people have done, and if you understand their trading strategies and you understand the decisions you have made, you can probably isolate that skill component pretty quickly. I believe for a CEO that is much, much more difficult. And again, I feel the boards just have a much better sense of who might be suitable inside the company than for outsiders. Sort of, again, explaining that gap and why it's also so difficult for a CEO to switch from one company to another.
Jules and I have a paper which in mutual funds makes this point very, very well. One of the points it makes, and that is when a mutual fund company promotes a manager within, a tremendous amount of value is added. When they hire an outside manager, no difference. No value added, no value lost. In other words, that information about their own employee is crucial.
See, now I learned something. So you're just telling me that there's asymmetric information even about the skills of mutual fund managers. And now my claim, and I can't prove it, right? And that's not also was kind of Jules' point, because the lack of a liquid market prevents us from estimating things very well here. But my gut feeling is that asymmetric information factor is going to be 10 times larger for CEOs. In part, the CEO job is such a weird one because it's different from any other job in the organization. What's required to be a good CEO? You need to have enormous people skills. You're leading people, you're inspiring people, you're dealing with lots of reports, and you got to get those people to work extremely hard. You got to be a leader. You got to get people to believe in you. And then let's call these the soft skills. But then you got to get all the big strategic calls right. And that's sort of one of the trickiest ones because there aren't that many of those. For a typical CEO, let's assume she has the leadership skills and the people skill and all of those soft skills. What she'll probably be remembered for are 2 or 3 big strategic calls. And they just happen very, very rarely. And you don't get to make those unless you are already a CEO. I mean, a fun little example might be Intel, which I believe missed the switch to mobile computing 15 years ago. Right. I don't actually know whether that story is true, but apparently they were asked to produce the chips for the Apple iPhone and decided to not do it, to focus on PCs and on the other activities they had, which obviously exposed was massively the wrong strategic call. I'm not the right person to judge whether it may have even been the right call at the time and they just got unlucky. But that CEO is remembered for having missed that call. Now, those kind of things are very, very difficult to predict. And I think boards are really, really struggling with trying to predict those things. So I think in many ways, again, a lot easier to hire a good mutual fund manager. Maybe there are mutual fund managers that have similar type of whatever big macro call investment strategies, where then again, I would posit that it's going to be very difficult to figure out how skilled they actually are. And I certainly, again, I think for CEOs, that is absolutely the case.
I really think the questions in CEO that your research gets to are first order, and the quality with which you bring the data to bear is impressive. Hopefully one day it'll have the kind of influence it should have in terms of getting the general public to understand that the issue of CEO overpay is a complete ruse. It's just not there.
Thank you so much. That's incredibly kind, Jonathan. I share the frustrations that you're expressing. There's a lot of work to be done, I think, especially here in the UK, to some extent also in the US. Hopefully this podcast might contribute just a little bit to righting the ship.
Thanks for listening to All Else Equal podcast. Please leave us a review at Apple Podcasts. We love to hear from our listeners. And be sure to catch our next episode by subscribing or following the show wherever you listen to your podcasts. For more information and episodes, visit allelseequalpodcast.com or follow us on LinkedIn. The All Else Equal podcast is a joint production of the Lauder Institute at the University of Pennsylvania and the Graduate School of Business at Stanford University, and is produced by University FM.